right, everyone, welcome back to the latest episode of the Great Retirement Debate. Ed, good to be back with you to argue about something else once again.
Yeah, if you've left your job voluntarily or involuntarily, and you have a 401k, a 403b, a company retirement plan, should you roll it over to an IRA?
All right, so what say you, Ed? Should you roll it over to an IRA?
Let's talk about the involuntary situation.
Okay.
Layoffs. Back in 2023, over 260,000 people, I don't even understand this, in the tech industry were laid off. You're talking about some of the most valuable companies in the world, Microsoft, Google, Amazon, most profitable, but that happened. UPS laid off people. Citibank in early January laid off 20,000 people. They say that's 10% of their workforce. So what's happening?
And this is good times.
Yeah, right. The market's up, everything's happening. So there are big balances at stake. So people want to know what to do with these balances. Should I roll them over to an IRA? And especially in the tech sector, I got to believe a lot of these accounts are heavy balances. And this may be a once-in-a-lifetime decision. You may only have one chance to get this right. Now, most people, even most advisors, sorry to say, the knee-jerk reaction is the IRA rollover.
Sure.
But is that always the best option? And take into account what you just said, Jeff, good times. At least early in 24, the market was way up and stock values were way up. So maybe there's other factors to consider before you just blindly do an IRA rollover, because once you do that, that's irrevocable.
Well, let's talk about what those options are in the first place, right? So certainly doing nothing is always an option. Leaving money in your existing employer plan is one option that at least most people have. A plan can, in theory, say, you're gone and so is your money and take it with you. But that's very, very rare. Most plans are happy to keep your money in there.
They want your money.
That's right. They're happy to keep it there. Now, certainly you may go back to work in another company, right? So you could have the opportunity to move it to a new plan. Maybe a scenario where you just take everything out of the accounts and take a distribution of everything known as a lump sum distribution, which we can get into in a little bit. Or you could engage in a Roth conversion, either in the plan or out of the plan to a Roth IRA. But those are basically your options, along with, of course, the most popular option, which is rolling it over to a traditional IRA. So let's start with the idea of, like, should you? Well, why would anybody want to roll money over to a traditional IRA? Why? You said the idea, at least most advisors would recommend that more often than not. What are some of the reasons that might be recommended?
I think many times it's because other options weren't considered.
Okay.
For example, maybe, and there are reasons on all of these, maybe you want to leave it in the company plan. Why would you want to do that? Maybe there are creditor issues. You have great creditor protection in a company plan. You have other benefits. Maybe it's the investments. But you should look at all the factors, pro and con, leaving it in the company plan versus the IRA rollover. I almost would say the IRA, if there are no other benefits in these other options, the IRA rollover is the default option.
That's fair. I mean, when you think about all the different things to consider, I don't know that we have time to get into every one of those nuances today, but creditor protection can be different between plans and IRAs, like you mentioned. Lots of states have great creditor protection for IRAs, but not all. So that can be an important difference. You noted there can be difference in investments. There can be differences in fees. There's even potential differences on the tax side. You have different withholding rules for IRAs as you do for plans. There are different, you can only do, let's say, a QCD from an IRA, and you can't do a QCD. That's a qualified charitable distribution. That's the ability for someone who's 70 and a half or older who is charitably inclined to use IRA money, which is a great asset to give to charity because it's all pre-tax in general, and to move it right to charity without any impact on the tax return. So there are definitely some differences. And again, all of these are things you might either have to research yourself or work with a financial advisor to discuss. But what are some of the times, or I guess, let's go the other way. What would be a reason not to make a rollover? Why would someone choose that like say, hey, I know that most people end up rolling it over, but the reason it's not right for me is because what?
Well, you mentioned some reasons to keep funds in a plan, but one of them was the lump sum distribution. Now, you might say, why on earth would I take all this money out and pay the tax? That's insane.
Well, let's make sure we hit on that, right? So a lump sum distribution, and we noted this before, but that does mean everything out, right? Not just out into an IRA, like out of retirement
taxable.
accounts. That's right.
Yeah, why on earth would I do it? Well, maybe there was a smaller balance and you needed the money. That could be possibly you're a low bracket. But I want to combine this, like I said before, with stock values being high at the time we're talking about this. You always have to say this because you don't know when somebody's, they'll probably, Ed, Jeff, what are you guys talking about? The whole market crashed. Or maybe it even went up further. I'm an optimist. I always believe eventually the market will go up. But let's say you were an employee, a longtime employee of a company, and in your 401k you had a stock of that company stock. There's a little known break, although I think it's getting more into the system, but for most people, they don't realize there's a big tax break for something called net unrealized appreciation in employer securities, or what we call for short NUA stock. And the big benefit is if you do a qualifying lump sum distribution, that NUA, and let me explain what that is. I'm going to give an extreme example. Not everybody has this, but in the tech industry, it could be possible. Over the years, your stock in whatever the company is, the cost was, say, $100,000, and now it's worth $1 million after all these years.
So you took $100,000 of your 401k money and bought stock of the company you work for.
XYZ, company. Okay. Right. Now it's worth $1 million, but now you're laid off or you're leaving the company for whatever reason, separating from service. Did you know that if you did a qualifying lump sum distribution, that difference between, and again, I'm showing you an extreme example to demonstrate the tax point, that difference between $1 million and the $100,000 cost is $900,000. That's NUA. In a qualifying lump sum distribution, you would only pay tax. You would remove all of that stock to a taxable brokerage account.
So the $1 million of stock.
Yeah, the $1 million. All of that comes out, but you only pay tax, ordinary income tax, on the $100,000. The other $900,000 is not taxed at all until you sell it. And when you do, even if it's a day later, you get to pay capital gains rates, the favorable long-term capital gain rates. On the other hand, if you rolled that all over to an IRA because you didn't know about this, number one, it's irrevocable. You can't go back and say, oh, I wish I saw this podcast before. Now it's in an IRA. You're going to pay all ordinary income tax. That's a big break. Not available to everyone. You have to have, first of all, it only works if the stock is highly appreciated. Because if I reverse the example, Jeff, let's say the cost was $900,000 and the stock was worth $1 million. Well, that's not worth it. Who wants to pay tax on $900,000?
That's right. Maybe only you do a small amount to fund your first year of retirement or something like that. But yes, I agree. It would a massive full-scale NUA transaction would not make any sense whatsoever well, at least for most people, unless you were going to spend all $1 million right away. Right. But in thinking about this a little bit further, it just goes to show that there's no one way for everyone, right? Not everyone has company stock inside their 401k, and if they do, not everybody has appreciated stock. But everybody is probably going to have choices in front of them, and a 10% penalty exception may be more valuable to someone than another individual, right? If you're 60 years old when you leave work, you don't really care about 10% penalty exceptions. But if you're 56 and you leave work, you care a lot about them. And one of the big exceptions is if you leave work at 56, you could take money out of your 401k without a penalty. If you move it over to your IRA, you can't.
That would be a reason to leave the money in the plan or go to a new company's plan if you want to take it out of there. And the age 50 exception for public safety employees is there. And even on the NUA break that I talked about, you could, in my example with the $100,000 taxable, you could pay a 10% penalty on that $100,000 if you're under the 55. But in that case, it might be worth it
to get the other $900,000 out without a penalty. Yeah, absolutely. I mean, there are so many different things that you could do, and so many different variables. Again, we talked about them being creditor protection fees, 10% penalty exceptions, investment options, also just platform. Right? You may have your accounts at a certain place, and you may want to simplify your life. You can also simplify your RMDs.
That's another point. Yeah.
If you have, the average baby boomer, I don't know if it's still true today, but the last time I looked at the labor statistics, it said the average baby boomer held 12.3 jobs inside their lifetime, which, look, I don't think everyone had a 401k, but let's say they had 2 or 3 or 4 different 401ks. Well, when you get to retirement age and RMD age, that means you have to take 2 or 3 or 4 different RMDs from each one of those plans, whereas if you kind of consolidated them in one IRA, which is kind of a nice nesting place for them, you only have to deal with one set of IRA or one RMD. Even if you roll them over to different IRAs, you still only have one RMD that you have to worry about. One IRA RMD can kind of, I think of it as like the Lord of the Rings rule, right? It's like one RMD to rule them all. It's okay.
No, that's one of the
nuances.
big reasons. People, first of all, once people reach RMD age 73 now, they want simplicity. They don't want to be messing around with all these different RMD calculations, make a mistake. So there's something for that. Plus control. They control their investments. They control their withdrawals. You know, sometimes there are benefits, as you said, to leave money in a company plan, but then you're under the company plan rules.
Yep. And I say no matter where you put your money, you want to make sure that your heirs know where it is. You know, Ed, in the most recent law, one of the things that I find most funny is part of the law actually creates, it sounds like a ridiculous thing that you'd have at school, the retirement savings lost and found. Right? It's like you went to school and you forgot your hat somewhere. It went to the lost and found. Now we have a retirement savings lost and found in case you don't know where your 401k money went.
No, people forget about these things. No, it's a real thing. Didn't they have something earlier, though, under the Pension Benefit Guarantee Corp, some version of that?
Yeah, this is like a new version of it where the government has to sink a lot more money in and help people track down what's missing. But, the fact that we even need to have a Department of Retirement Savings shows you how many people are not keeping track of these dollars. And if you have 3 or 4 or 5 or 6 different 401ks, it's a lot harder to keep track of them than one place where you've consolidated your assets.
Yeah, no, that makes perfect sense, and that's one of the winners for the IRA rollover, consolidation and control. And also for estate planning, you can split up assets, name different beneficiaries. Sometimes the people at the 401k, you got to go through a lot of red tape. You can't always get the plan you want for your estate plan. You're more likely to get a better plan in an IRA. But the bottom line with all of this is that if you have a lump sum available to you, separation from service, we started talking about all the layoffs, which triggered a lot of this, but there's some people that just, they're retiring, or they just wanted to move money. They have, like you said, the money all over the place. But if they're retiring and they have this big 401k, maybe you want to have more control over that, but you want to explore every option to see which option is best for you.
So ultimately, Ed, started off today's episode asking the question, should you roll money from a 401k over to an IRA? In 10 or 15 seconds, what's your answer?
In most cases, yes, unless there are factors like the creditor protection, like the NUA, that are clearly a benefit to you in your situation by leaving it, say, in a company plan or a lump sum distribution.
Yep, I'd have to agree. There's a reason more people, and the default, if you will, is almost the IRA rollover. It's probably the right move for most people.
Most people.
But you're not most people. You're you. And your facts and circumstances may be different for someone else, so it's important to know which of these options is best for you. So let us know. What do you think? Is the IRA rollover the right move for you? You can reach out to us on Twitter, Ed at The Slot Report, and myself at CPA Planner. We'd love to hear from you. And thanks so much for joining us for this episode of The Great Retirement Debate.